One of the first known family offices was set up in the late 1880s. This is the Rockefeller family. So they are trying to generate returns, sure, but they are also trying to make sure that wealth is transferred well between one generation and the other.
Everyone has heard this saying that don't put all your eggs into one basket. That's the basic of investing. That's what diversification means. But for a lot of people, that only means maybe buying different stocks or investing in a few more mutual funds than usual. But what does diversification mean for an HNI?
They are not diversified. They don't look at diversification in terms of a product. They are looking at diversification in terms of when an actual crisis happens. Everyone feels fear the same. I have sat across rooms with very wealthy investors whose faces sort of turn the moment you tell them that look, your portfolio lost so much money. The average HNI family has about 30% or so in real estate. However, the key difference compared to a real estate retail investor is that they don't really own as much of flats or physical property or land anymore directly.
When markets crash, most people panic. They check their phones almost every 5 minutes, sell at losses, trying to recover whatever they can. But the 1% of this population, they do the exact opposite. And today we'll be breaking down how the wealthiest people in India look at money differently, how they invest and try to build their own wealth. And for that, we welcome you to the Good Luck podcast. My name is Simran, and today we have with us Mr. Anirudh. He is the head of Indian Asset Management India at ST, and he is the perfect person for this conversation because he deals with HNIs and retail investors daily. So, welcome, Anirudh.
Thank you so much, Simran. In fact, it's a very relevant topic because they think very differently. In fact, the investor behavior overall is, poles apart in a way. So, happy to sort of talk about what my experience is.
Yeah, so let's start right into it. I wanted to ask a broader question. Like you said, that you have experience in terms of talking with both the investors, so you
Mhm.
understand their behavior, their pattern. So, in terms of mindset, do you think there's a vast difference between how these investors think, or there are some similarities between an HNI versus a regular investor?
Well, as I mentioned, let's try to sort of look at the mindset of each investor, right? So the average retail investor, they are trying to become wealthy. They are trying to build wealth. So, they're trying to identify what's the product. They're trying to pick products that's going to outperform or, help them generate that return. If you compare that with a wealthy investor, somebody who's an ultra HNI, these guys are trying to remain wealthy. They're not trying to build wealth as such. So for them, the process, the structure, the safety of the investment, as well as post-tax returns or post-tax compounding is what is very important. So, if you look at the average retail investor, they are very emotionally tied into all their decisions. So, they're trying to save to buy a house, they're trying to save for their children's education. There is a lot of emotional tie into each of their decisions. And as a result, each time something goes wrong or, the market crashes, for example, the losses hurt so much that they end up sort of selling winners and they end up holding on to losers. This is a very standard sort of investor behavior that you would see. And this is something which is again amplified. The SEBI paper that had come out recently about this. I mean, this behavior is something which is very clearly reflected here. If you compare that to an ultra HNI investor, these guys they have very clear perspective about how to behave or how to react when it comes to a market crash. So what they are trying to do is not chase just that one fund which is generating the best returns. They are trying to do this in a very systematic manner, in a very process driven manner. And as a result, they are not forced sellers. So whenever the market crashes, the retail investors, just trying to hold on to what they have. Whereas the HNI investor isn't really trying to do that. They are trying to rebalance their portfolio. They are trying to identify that, oh, within this crash, is there an opportunity that I have? So their next sort of holiday or their next meal, I mean, meal is probably an exaggeration, but their next holiday is not dependent on how well the market does in the near term. So overall, they have a lot more liquidity and a lot more holding power. So they are not forced sellers, and that is the primary difference between the returns that a retail investor generates versus what an HNI generates.
That's really interesting. Just expanding on the behavior of an HNI versus a retail investor. So when we look at investments, one of the factors that everyone look at is returns, and that's actually where they limit their research to in terms of selecting their investments or even analyzing where they have invested. But when it comes to these wealthy families, do they look at returns as the only factor? Is that what matters to them the most? Or do they look at something else entirely when they assess if the investment is doing well or not?
So, let's go back to the concept of a family office. So, one of the first known family offices was set up in the late 1880s. This is the Rockefeller family. Uh, what's important to understand is what their objectives are. So, they are trying to generate returns, sure, but they are also trying to make sure that wealth is transferred well between one generation and the other. They're trying to make sure that taxes are managed efficiently. They're trying to manage their philanthropic initiatives as well. So, the way these guys think about wealth is very institutionalized compared to how a retail investor thinks about it. And in India, of course, because of the IT boom, because of the IPO boom that's happened, there have been a lot of first generation entrepreneurs who've come into a lot of money. So, if you look at statistics, there are more than 300 family offices now, which essentially means that these wealthy families, they employ individuals who are experienced to run their portfolios for them, in addition to sort of working with wealth managers. So it's gone up to more than 300 today. If you look at the ultra HNI segment, India has 13,000 plus ultra HNIs today, and this number is expected to go up to almost 20,000 in the next 2 or 3 years. So for all of these people, it's not really as much about uh, picking the right fund. It's more about systematically managing this generational transfer of wealth. And if you look at the Indian, the wealthy Indians as such, more than 1 lakh crore of assets that they have are going to be transferred from one generation to the other over the next few years. So, their investment offices, their family conversations are not as much about have I got that 2% extra yield? It's about making sure that all their objectives are being fulfilled correctly. So, they would look at post expense, post tax, post inflation CAGR. Whereas the average investor is just looking at gross CAGR. For them, if you tell them that, oh, this investment is giving you a 12% return versus the other investment at a 10% return, they would most likely just go and pick the 12% number. Whereas the wealthier families, they have systematized this process to such a great extent that for them, it's only the return number after expense, after tax, after inflation that matters. So they are picking net CAGR as opposed to gross CAGR. That's one of the very big differences
Yeah, as
between
it
both.
should be, I believe.
Yeah.
Moving on, everyone has heard this saying that don't put all your eggs into one basket. That's the basic of investing. That's what diversification means. But for a lot of people, that only means maybe buying different stocks or investing in a few more mutual funds than usual. But what does diversification mean for an HNI? Does it have any difference in terms of when markets crash? Does diversification behave differently for them? What is the outcome over there?
No, in fact, this is a very pertinent question. When I started my career, at that time, it was the first time when, we were selling PMS products to wealthy families. And I was, their approach really struck me as something which is very logical. So, coming from, let's say, a retail investor mindset or a retail investor background, what I saw is that every retail investor thinks they have diversified. So, they have 15 funds, they have 30 stocks, and they think they're diversified. But in reality, they are essentially facing the same market weather. They essentially have access to the same 100 or 200 odd stocks across all their 15 funds. It's just 15 different names they are invested across and 15 different expense ratios. In reality, all their portfolios or their entire portfolio is sort of will succumb to a market crash at the same time. So in reality, they think they are diversified, but they are not diversified. So if you compare that to an HNI investor, they are not diversified. They don't look at diversification in terms of a product. They are looking at diversification in terms of when an actual crisis happens. I think, therein lies the real difference there. So if you look at HNIs, they run this liquidity ladder sort of a thing. So they have identified sort of liquidity profiles and, tied into time vintage, wherein some assets can be sold today, some assets can be sold a few years later, some assets can be sold 10 years later. So in reality, their diversification works across liquidity and time in addition to products. That is one real difference. And uh, for them, rebalancing asset allocation, these are the real diversification metrics that they end up looking at. So, if you are invested in multiple uncorrelated assets, we may think we are diversified, but unless we are buying what has fallen and selling what has risen, we are really not taking advantage of that diversification. And this is essentially what these wealthy families are good at, because they are not really forced sellers for anything for that matter.
Got it. So, just talking about market cycles now, we have seen that when markets crash, the usual reaction of every investor is pure panic.
Mhm.
They usually see how they can get out of this or how they can save whatever is left of their portfolio.
Mhm.
But what does an HNI investor think during this time? What goes on in their mind and how do they approach this?
you know, uh, I think there is a misconception that people have where they think that the ultra HNI investor or the family office investor does not feel fear. I think that's a very sort of, it's a very misplaced concept. Everyone feels fear the same. In fact, uh, fear when there is a crash is something that does not, go up or go down depending on the kind of wealth that you have. So that's a very mistaken concept. I have sat across rooms with very wealthy investors whose faces sort of turn the moment you tell them that, look, your portfolio lost so much money. So I don't think it's really about them not feeling the fear. The fear is felt equally by everyone, and it's the same. The difference is that these wealthy investors, their response to that fear is very well calibrated, very well thought out, and it is probably decided with their advisors multiple years even before the crash happens. So, when the crash happens, they have their emergency funds, they have their extra liquidity to look at this as a buying opportunity. So, I think, that's where the real difference lies. And as a result, they are not forced sellers. Going back to the first question that we talked about, which is the difference between a retail and a HNI investor, is that when panic strikes, the retail investor feels like, okay, let's just salvage whatever we have and let's just sell and sit on cash. Whereas the HNI investor does not think like that. For them, they have predefined investor policy statements. They have asset allocations very well defined. So, they're very clear that, okay, I'm going to hold 5% or 10% of my portfolio in gold or silver at any point in time. And then they rebalance at a certain frequency. The other difference between retail and HNI investors is that when markets are falling, or even when markets are rising, the retail investor looks at his portfolio every day. And that leads to a certain type of behavior. It leads to euphoric behavior when the market goes up, and it leads to a lot of panic setting in when the market goes down. Whereas the HNI investor, he probably looks at his portfolio once a month or once a quarter. They don't really, they don't emotionally let themselves get regulated or react each time there is a change in how the market is doing.
Got it. So the difference is not in terms of how they react, but how do they solve the problem, or like basically how do they approach their investments right after that?
When you have thought of all the scenarios, they know how they will react in a crash, they know how they will react in a super cycle. So these are things that they have already thought about when they sit with their advisors years ago. So these are situations they've already anticipated. But as a retail investor, when I'm trying to save for my child's education, then that crash makes me feel like, oh, everything's going down. So therein lies the difference. The feeling of fear is the same, but the reaction is very well calibrated in case of an HNI investor and very emotional when it comes to a retail investor. That's the difference.
Got it. Okay, let's talk about real estate for a
Mhm.
minute because we know that in India that's a sacred thing. Every household thinks that real estate is the safest bet in terms of making
Yeah.
wealth. So, do the HNIs also believe in the same? How much of their portfolio is actually invested in real estate?
So, firstly, I'll tell you what happens with real estate, at least in my experience. Real estate feels like it's a safe bet because, people see that property in front of them and, they are not looking at daily price changes there. So, there is no volatility that is visible. Now, uh, if you look at Indian real estate, 2000, the years 2000 to 2013 was a super cycle for real estate, 20% type of CAGRs during that time. And an entire generation's wealth was built on top of that. Now, if you look at the years, and so of course, that mindset has been set that, real estate is a great investment and that's what is going to lead to returns. However, that's been one cycle. It's not expected to go on eternally. It's not like real estate will grow 20% eternally. If you look at 2013 to 2020 timeframe, Delhi, NCR, Mumbai, these tier one cities, their real estate markets have lost almost 15 to 20% during this time. However, no one feels it because, as I was saying, people don't watch real estate prices every day. And, a lot of them are living in the same property. So there is no reason for them to look at it. So that volatility is hidden volatility. People just don't end up feeling it, right? And today, if you look at the average retail Indian investor, until some time back, 50% of their household savings were in real estate, about 15% in gold, and only 35% in financial assets. But gradually, the financialization is increasing. So, we are now moving to about 40-45% sort of numbers in financialization or financial assets. And that's something which makes a lot more logical sense. And people have also sort of, realized that real estate is not really giving the same kind of returns. So this is about retail investors. If you look at HNIs today, the average HNI family has about 30% or so in real estate. And that number is also shrinking gradually. However, the key difference compared to a real estate retail investor is that they don't really own as much of flats or, physical property or land anymore directly. They are essentially moving towards financialization of real estate also. So, real estate investment trusts or REITs as we popularly know them, that's something which has got a lot of, HNI money or ultra HNI money recently. Similarly, real estate backed AIFs, these are generating very solid CAGRs because of commercial residential yield, and HNI money is moving there. In fact, if you see the last year in Delhi, I think Delhi NCR, almost 71% of transactions that happened in the first quarter of this year were all in ultra premium real estate. So, that marks again another shift. So, the ultra premium real estate market has seen a lot of transaction and, there is a boom there. But the affordable housing segment has been stagnating. And finally, the last trend is that HNIs are not just taking equity interest in real estate, as in they're not necessarily just purchasing real estate, they are also lending to real estate. So instead of being buyers of real estate properties, they're becoming lenders to real estate as well. So those are some of the key differences that we've seen based on data.
Very interesting. Continuing with the same theme of traditional safe bets, now gold and silver have seen a massive run lately,
Mhm.
and people have been talking all about it. So, how do HNIs see gold and silver in their portfolio? Do they also view it as like a safe haven, or is it more strategic in nature?
See, I'll tell you how, in my experience, what HNIs think about gold and silver is they always have some allocation of the entire portfolio to precious metals. They think, and they don't club gold and silver together. They're very clear about the differentiation. So they think of gold as insurance, it's like the safest bet that they can have. But they look at silver as a leverage industrial trade because a lot of the use case of silver has been in semiconductors or different industries more recently. So HNIs are very clear about the distinguishing or the difference between both of these things. uh, Secondly, because of portfolio rebalancing, right? So gold has peaked in, let's say, Jan of this year. um, the moment HNIs realize during periodic rebalance that the value of gold is much more than what their target asset allocation is, they start trimming. So they start reducing the allocation. So what that does is that instead of, they're not trying to time the market. I mean, let's be very clear about that. They know that over the long run, let's say if they want 10% allocation to gold, the moment gold has moved to 13 or 14% because of gains in gold, they will try to reduce the gold allocation. Similarly, if gold has fallen and gold instead of 10% has come down to 7 8%, they would buy. So in a way, while they are not trying to time the market, but they are selling what has gone up and buying what has remained low, because there is very high conviction that they want to stay invested in these precious metals for the long term as a permanent asset allocation. So that is one of the perspectives that HNI investors have. If you look at retail investors, a lot of the money in gold and silver ETFs, about 1 lakh crore has gone into gold and silver ETFs in the last year. This is almost two times of what has gone into equity ETFs in the same period, which is very interesting and actually very surprising. And the data also supports the retail behavior and their mechanism of buying things when it has gone up. So gold peaked in Jan of this year. It's come down 22% since then. Silver peaked around about the same time or a little earlier, and silver has come down 15% in the last month, even though it is 70% up year on year. But that is essentially where the key difference lies. Retail is typically buying something after the excitement is over, and then realizing that the same returns aren't available for them. So that's essentially one of the key differentiators, at least to my mind.
Got Got it. So shifting the gears a little bit here, every financial influencer right now out there is like, read this book or read that book to learn about investing. So just wanted to check with you, do HNIs actually sit and read these books? Is that the best way to learn about investing, or is their learning process completely different?
Look, you know, whether you want to read about finance or investing is a lot about, it's really a personal choice. It's not like, the HNI investor is sitting and reading all of these things. So I think what they do very well is, whether they are well read on finance and investing or not, they are great at assessing judgment. So essentially, while your average retail investor is trying to understand who is the best manager out there, or their questions are more about returns and how the performance has been, the the HNI investor is essentially trying to assess advisors, it's trying to assess their wealth managers, it's trying to understand their incentive structures. So the first question isn't really what return you generated. The questions that a family office would ask a wealth manager or an advisor is, what was your worst drawdown? Or they would ask them, how do you get paid? So long before the average retail investor became educated about direct plans and mutual funds, HNI investors were doing this all along. So the distributor model versus the advisor model, right? So that's something which has been going on with HNI investors since the longest time. They're very clear that hidden commissions reduce their returns. So that incentive alignment is something which is a very important aspect when it comes to assessment by ultra HNIs. So that is one of the key things. And the other difference also is that people don't get ideas by reading these books. Your the average retail investor, they get a whiff of an idea or a narrative once it comes out in the media. And once something comes out in the news, everybody gets access to that information. Whereas the HNIs, they pick ideas directly from deal rooms much before it comes out in the mainstream. So before money is chasing ideas, these people already typically have access to it. So it's a lot about obviously more access, but at the same time, they're very clear that I'm not really chasing that 1% extra return. What I want is the right advisor who has the right incentive to manage my money wisely. I think that's one of the key differences.
Right. Right. Now, this part I'm really curious about: angel investing, startups. So there is this buzz that everyone wants the next piece of a big unicorn, right? They want a piece of the next big unicorn that's there in the market. And we wanted to just see if, how do you feel honestly about HNIs doing angel investing, and is there any minimum portfolio size as per you, after which it starts making sense to actually start investing in these startups?
No, it's a very interesting question because today, uh, I think the mistake a lot of people make is that they're looking at angel investing or startup investing as an asset class to which they need to have allocation. Now that's a very dangerous concept, and I'll tell you why. Because typically, if you look at all these angel deal data, you would see that about 70% of investments typically yield less than 1x in terms of actual outcome, which means 70% of investments lose money. About 10% of investments make some money, or make, let's say, 2x or 3x of what was invested, and it's only the top 2-3% which leads to that staggering 20x type of returns. Now what does that mean? It really means that unless you're writing 20 to 30 checks over a 3 to 5 year horizon to different startups or different founders, it's very unlikely that you will actually have that top 2-3% of 20x returns which you are looking at. This is very important to understand because typically, if you look at the size of each of these deals, it's typically anywhere between 10 lakhs to 5 CR. And if you want more stability in your portfolio, it's probably not advisable to have more than 5 to 10% of your entire portfolio in startups or in angel backed deals. So from that perspective, unless you have a certain minimum portfolio of 20-30 CR, it's probably not advisable to start cutting checks directly to a startup, because then you are putting all your eggs, as we said, in one basket, and that basket could probably just be in the 70% of startups which don't perform or which lead to losing money. So that is that's one of the first things to keep in mind. Secondly, if you see how HNIs think about angel investing or startup investing, their first question really is, why does this founder want my money? What am I adding? So am I adding credibility? Am I adding some resources or some distribution muscle to them? Or is there some expertise I'm bringing? So is there some synergy between me and them? So that's the first question they ask. And if they don't see any synergy, I mean, it becomes more like an adverse selection issue, and that suspicion comes up. So why does this founder want my money at all? So today, if you see how HNIs think about it, they look at least when they're investing directly in startups, they look at it from a synergy perspective, or why the founder wants my money. If not, it goes to the dustbin and to the discard pile. So that is one of the perspectives that all HNIs have typically before investing. Of course, a lot of people are now doing startup funds also. So by doing that, of course, you can manage your portfolio allocation better. You may have a 5 CR portfolio, and you may invest 50 lakhs in a startup fund. So you're still at 10% of your portfolio, and you'll still get access to 20-30 different startups by going through a fund. So unless you have a certain minimum portfolio, it doesn't make sense to start cutting checks directly to startups. If you're still very interested, sure, go by the startup fund route, but that also would be after a certain minimum wealth.
Understood. So here's a fun question for you. We've all seen in the movies, right? There's this rich guy with a nice vintage car collection, or paintings worth crores, or a rare watch. So we just wanted to check that, if this actually serves some purpose in their portfolio, or is it just to sort of contain their own interests and hobbies?
Very interesting question again. I think we could use the same lens as we were doing for angel funds or startup funds when we look at collectibles as an asset class. So one, it is very liquid, right? I mean, you may invest. If you're thinking of it as an investment, it's very unlikely that you'll be able to liquidate it very easily. If you look at data from some of these auction houses, what you would see is that typically most of these yield nothing pretty much, or they may not yield any return per se. uh, but it is that one masterpiece that will get you 20x, 30x, 40x kind of returns, right? So unless you are in the trade or in the business of collecting art, for example, it's very unlikely that you'll be able to spot that masterpiece. Or by the time you spot that masterpiece, it is probably already risen in value. So I think that's one of the that's probably the lens one needs to put on when you're thinking about collectibles as an asset class. Typically, HNI families would not invest more than 2-3% or maybe at max 5% of their assets in collectibles as an asset class. That also they would typically do from an investment perspective only if they are genuinely very interested in it. Otherwise, all these luxury buys are just something they are spending on because they want it. They don't really have a very high return expectation from it. However, there are three key benefits if you analyze collectibles as an asset class. First, they are freely movable across borders and across currencies. So today, let's say if you move from America to Singapore, you carry your art piece with you. You don't have to, transfer your money from one currency to the other. So that is one perspective. Second is even when it comes to intergenerational transfer, there is a lot of valuation flexibility that these assets bring along with it, right? Even in places where there is wealth tax, there is a lot of valuation flexibility because there is no market per se for these things. And until you are selling, it's very unlikely that you really need to put a fair market value to it. And then finally, people who are seriously into collectibles, they are able to use these collectibles as some sort of leverage also, in the sense that something that is, let's say, a masterpiece. If somebody owns it, they may be able to get a bank line of credit against that without actually selling it. So it does have value from these perspectives, but again, unless you really understand the market very well for, let's say, art or luxury watches, it's very unlikely that you'll be able to spot that masterpiece unless you're really lucky. So it's like a lottery ticket in a way.
That's actually very interesting.
Yeah.
Okay, now let's move on to more of a practical question. So, most of us, we open our portfolio and review it only when the market is crashing and there is immense panic with the investors. But how do HNIs approach this review process? What are the answers that they look for in conversations with their wealth managers when they are reviewing their portfolio?
Okay. So, I'll start off with a statistic that the return CAGR that equity mutual funds have made in India is far more than what retail investors have made in the same equity mutual funds. Now, what that means is that they are clearly doing something in terms of their decision making that is leading to suboptimal returns, which again goes back to that panic selling question, right? What is counterintuitive and what most managers or most advisors won't tell you is not that the retail investor does not review. uh, in fact, they glance at their portfolios every day. Research shows that the average retail investor looks at their returns every day, and this leads to some sort of a psychology, a paralysis, in the sense that they become extremely risk averse as a result. So when you observe market movements every day, you start becoming extremely risk averse and you take incorrect decisions. If you compare this with an average HNI investor, the HNI investor probably just reviews once a quarter or once a month. The retail investor is probably going to ask a question during a market panic. The question they would ask is, how much did I lose? And they're looking for some sort of comfort from whoever they're asking this question to. Whereas the structured, institutionalized family office or ultra HNI investor is going to, reverse the question. Their question would be, does something need to change or are we okay? So, they are far more comfortable during these crashes because, as I mentioned earlier, right, they have anticipated these situations and they have calibrated their responses to these. And they go a step further. They are asking, is there a buying opportunity? So they are not looking for comfort. They are looking for confirmation on whether everything is within their risk tolerance limits and is there really an opportunity that is coming along with it. So I think that is sort of, one of the key differentiators between both.
Yeah, so they don't react on emotions basically,
Yeah,
but more
absolutely.
towards a strategic plan.
Yeah. And the reviews are not, I mean, they're not looking at prices every day. Even if they are, they're probably not looking at their portfolios every day at least.
So we just wanted to do a quick exercise with you. Say there's this person who has 50 lakhs to invest today and they need to start completely from scratch. How would you help them build their investment portfolio? What would be the steps that you would advise them to do?
Okay. So I think the 50 lakh number is very interesting because this is typically the threshold for products that are more HNI or UHNI. Let's say like a PMS or maybe an AIF feeder in a way. So the moment you get to a number like that, you start getting onto the radar of all of these wealth managers or all of these distributors, or at least the mid-sized or the small-sized ones. However, what's important to keep in mind is that while this kind of portfolio or money to allocate gives you access to these products that are suitable for a HNI or an ultra HNI, do you really have that kind of diversification? Do you have that kind of cushion before you allocate all your eggs in one basket? That's a question to ask. So I would say, we should go back to the basics. Instead of finding products, we have to think first about fixing behavioral patterns. So first, write a one-page investor policy statement. This should have all your goals. It should have all the buckets in which you want to allocate money to, and it should have the allocation. Think about products only later. So you need to have. So as I mentioned, so first write an investor policy statement which should have your goals first up. Second, it should have the allocation that you want to make. Third, it should have rebalancing frequency. And fourth is review frequency. So these are four key things if you want to sort of, change your investor behavior and align it with what HNIs or more institutionalized family offices work with. Along with that, three or four key things to keep in mind. Set aside your emergency funds. Make sure you have set aside money for insurance, for other essential needs or goals that are coming up. And after all of these things are done, whatever is left is what you should allocate to a portfolio or construct a portfolio out of. So the product is really the last step in this whole process.
Thank you for that cheat sheet, Anirudh. Lastly, I just wanted to check with you, Anirudh. So, say there is this person who is nowhere close right now in terms of making HNI wealth. But what would be the three habits that they can steal from how an HNI operates, and how can that help them with their investments?
Again, very, very interesting question. I think there are some behavioral patterns that we can take from, I mean, more than the rich, it's more institutionalized ways of thinking about money management or wealth management and apply that to a retail investor. So I think the three habits that I would talk about is first, habit number one, never be a forced seller. We'll elaborate on each of these. The second one is decide everything in writing in advance, which is, the reactions that you have to market crashes. And the third one is review on the basis of a predefined calendar or schedule instead of in response to sort of a red candle, which is like a technical indicator. I think if someone is able to imbibe these habits, this could lead to a difference of almost 4 to 5% a year of return, which is one of the data points we were referring to earlier. Whereas funds have generated more returns, but retail investors in those funds have generated much lesser returns, almost 4 to 5% compared to what the fund has generated. So I think what is important is that the rich don't outperform because of what they have access to. I mean, that's a very small part of it. The real outperformance comes because they have decided in advance in writing what not to do.
Hmm.
I think that's a very important point here. Let's talk about each of these three habits, which we've anyway covered during the course of this discussion, but I'll just sort of summarize each of these. The first one is don't be a forced seller. For the average retail investor, your retail version should be one, you should have 6 to 12 months of emergency funds lying around at any point in time. Second is you should not have any leverage against your investments, because the moment you are leveraged against your investments, things like MTF, etc., which is getting so much in vogue today. However, the moment something falls, you are forced to liquidate, right? So you are becoming a forced seller. So that's the second one. And the third one is don't invest funds in illiquid products, especially if you have a very clear 1 to 3 year use case for those funds. uh, this is the one single habit wherein in case of crashes, you're not going to be a forced seller. In fact, you may even have the opportunity to buy at the time of crashes, which may give you better returns, right? So this is habit number one. Habit number two is decide in advance in writing, as we discussed. So, write out your investor policy statement. Wealth managers charge 0.5% to 1% to actually do this for you. But it's very straightforward. You can, on a calm Sunday, you can decide this, and this will sort of help you regulate your actions on a manic Monday or a terrible Tuesday, which is, probably days when the market has fallen significantly or losses keep on compounding. So, as we discussed, write your investor policy statement, fix your goals, fix your buckets, which is asset allocation, figure out your rebalancing date, and your reviews. And the third one is, as I mentioned, review as per a calendar. We talked about how daily glances at what is moving up, what is moving down leads to irrational behavior. So instead of that, if you do it on a certain frequency, which could be monthly, quarterly, annual, however, whatever makes sense for you, uh, that will help you calibrate your behavior. And instead of panicking and asking how much did I lose, you're going to ask, do I need to change anything? So these are the three key habits.
Okay, thank you so much, Anirudh, for that amazing conversation. I think everyone who is watching this, including me, we would be looking at money in a different way now. Maybe something similar to how the HNIs are looking at it, and maybe have a more structured process towards our entire investing journey. So, thank you so much for being here.
Thank you, my pleasure.